All right, so as we look at Best Buy and we're doing the as-is valuation, one of the things that you probably noticed is that here in the Assumptions tab, they didn't have anything for operating leases in Bloomberg. And if you looked at the Data IS tab or Data BS tab for the balance sheet, you'll notice that the operating leases, which were historically pretty large for Best Buy, suddenly go to zero. So that obviously is probably an anomaly where Bloomberg did not enter in that data point. So if you go look up their 10K, and here is their 10K, on page 51 of their 10K, it specifically says that they have off-balance sheet arrangements, and then they say, other than operating leases, we do not have any other off-balance sheet financing, and you'll notice that they have operating lease obligations of $7 billion, $13 million. So basically we can grab those out of the 10K. So that is the 7013 that I ended up putting in the model. So again, even with these data services, they're not all perfect. They don't always have all of the information. And so again, in this case, we would have had to go to the 10K to get the additional information that we were missing to do the valuation. So 7013. Okay. All right. So that gets us a share price of $5.50. Best Buy is trading at approximately $40 a share today. We're going to need to get the value a little bit higher. And one of the things is that Best Buy was growing at a pretty rapid clip up until the recession, and also their competitive challenges with Amazon. They're not really expected to grow that much in the next 2 years after shrinking dramatically in 2014 with a bunch of store closings. So, obviously we're going to have to get their share price higher. Even if I start getting 2 or 3% revenue growth, I'm still only at about $8 or $9 a share. So one of the things, and by the way, they have this kind of crazy tax rate the last 2 years. So I did an average of the first 4, skipping the last 2 to kind of normalize. So even with a reasonable tax rate and getting back to a growth mode, they're still probably going to have to get improved margins. And so ultimately, let's look at the margins. To match the assumptions, the margins are going to improve for the next 2 years from an initial model operating profit to hit the consensus, so I put those in. But ultimately, what we're probably looking at is probably even better margins. So if I look at their operating income, right now it's around 3.5%. They previously were as high as 4.5%, 5.5%, 5.4%. So I can start improving that. So again, if I go to, call it 73 for cost of revenue, 72, and then maybe 71, 69. I'm kind of getting closer now, 40, 47 a share, and again, they're approximately $40 a share today. So basically, what the market is really saying is if they get to somewhere around low single-digit growth, they're probably looking at an operating profit pre-tax that needs to be somewhere in the 6% or higher range in the out years, and you're looking at 4 to 5% no-plat margins from right now around 2% to justify their current share price, which leads me to believe that we don't even have to get to the final valuation to say I'd avoid Best Buy. Right? Now shop there on Black Friday if you think you can get some deals, but from a shareholder standpoint, I really worry that their share price right now might be a little overvalued. So in a best case scenario, I think a hold would be appropriate, but I'm probably leaning towards the hold sell based on some very superficial analysis because the market is already basically having to infer a pretty good improvement in their margins to justify their current share price. Okay? So when it comes to Best Buy, like I said, I'm probably going to be in the hold sell category. Now, the other reason why I wanted to do Best Buy is I wanted to talk about the implied multiples. So I'm going to go back to Bloomberg. I was looking at their historical share price. But if I go to the RV section of Bloomberg, this is where we're going to get our multiples. And this is where we had created our multiples template for the company. And I tried to pick 5 peers of Best Buy, and I chose these 5 peers. So remember, for your analysis, you're going to have to narrow the list down to 6 total companies, your company plus 5 others. I included Walmart, Staples, GameStop, Conn's, and H.H. Gregg. Conn's and H.H. Gregg are basically Best Buy wannabes. Conn's appears to be a company I hadn't previously heard of that does Best Buy-like stuff in Texas and Louisiana. And H.H. Gregg is kind of mid-Atlantic and south. But basically the more regional versions of Best Buy / previously Circuit Cities. So I picked these companies, select stats, market cap weighted average. So this gives me sort of the market multiples for each of these companies. So I'm going to dump this to Excel, these multiples. And just to make the data a little bit easier to read, I'm going to take all these down to 2 decimal places instead of having 3 decimal places. And file, save as Excel workbook. And I'm going to call this Best Buy Comps. Previously done in an earlier section, so I'm just going to overwrite that file. All right, so I just basically dumped it in. The other thing is these aren't numbers, so select all, copy, paste special, values. I want to make sure that they are numbers. So again, file, save as my Best Buy Comps, overwrite. Okay, so I'm going to go back to Excel here, our model, and then I'm going to open up this Best Buy Comps file that I just saved. Okay, there's all the data. And what I'm going to do is I'm going to take this comps sheet, comps is short for comparables or multiples, and I'm going to right-click on it, and then I'm going to say move or copy. In this case, I don't want to copy, I want to move it, and I want to put this into my valuation model for Best Buy, and I want to put it here at the end. So now in my Best Buy model, I have my multiples spreadsheet. Okay, so there are my multiples. Okay. All right, so here's the final step we want to do for our model. These are the multiples as of right now for Best Buy in the real world. However, they're based on the current stock price of Best Buy. In our model, we are estimating a stock price for Best Buy. Well, that estimated stock price would infer a multiple. Okay? It would infer an enterprise value. It would infer a multiple of enterprise value to sales, enterprise value to EBITDA, etc. So that's what I want to do. I want to use these, and we're going to call these implied multiples, but the implied multiple of my final stock price. So let's just say that I've done my final valuation in my model, and right now let's assume this is my final valuation for simplicity. That would then get me a multiple based on this stock price. So that's what I want to do. I want to look at the multiples that I created based on the stock price that I'm forecasting in my model. Essentially a forecast of a multiple. So here's the last step, which is the enterprise value that is used in Bloomberg. So go back to Bloomberg here, is calculated differently than the enterprise value in our model. If I go back to the FA section of Bloomberg for financial analysis, you'll see that Bloomberg calculates an enterprise value. And here's the current enterprise value they're using for Best Buy enterprise value to sales, enterprise value to EBITDA, etc. Now, one of the things you'll notice is that they define enterprise value right here. They take the market capitalization, which is the value of the equity. They add in the value of the preferred and common stock, and then they subtract all cash and cash equivalents. Right? Now, if you think back to our process that we've defined in class, we didn't do it quite the same way. We said that enterprise value was the debt and the equity, right, which also equaled the operating plus non-operating. Now, what they're doing is they're taking debt and equity, and they're subtracting cash. Right? Well, if you think about it, in our model, cash is non-operating. Right? So they're kind of taking a 3 and a 4, and they're subtracting a 2. Right? So if you really think about it, enterprise value in a data service like Bloomberg or CapIQ is actually closer to what we would call the operating value of the firm. Right? Because it basically says take what we would call the enterprise value, subtract out all the cash. Right? And we would normally just subtract out the excess cash. They're actually subtracting all the cash when they do net debt to get what's left, and they're calling that enterprise value. And for us, that's closer to operating value. So in a way, the enterprise value used by the data service is a proxy for the operating value that we calculate. So the challenge is, if I do the implied multiple, I can't use the enterprise value that we're calculating in our model because it's not calculated the same way in the multiples. So in order to do that, I'm going to put in what I'm going to call the Bloomberg equivalent enterprise value. So I'm going to recalculate enterprise value the way Bloomberg would do it so that I could actually compare the enterprise value with the EV to sales, EV to EBITDA, EV to EBIT in Bloomberg. So how do they do it? They took the debt plus the equity. So in this case, I'm going to take the common equity value. I'm going to add in the debt and add in any preferred. You can see that that's basically, we go to Bloomberg here, preferred and debt minus the cash. Right? So minus from my balance sheet for 2013 all of the cash. Operating cash minus excess cash. And that's going to get me what I'm going to call the Bloomberg equivalent enterprise value. Okay? So debt and equity, debt, equity, so common preferred debt minus cash. That's closer to the Bloomberg enterprise value. Right? So what does that mean? That means that in this sheet, which I'm going to rename comps in my model, I'm going to have a row which I'm going to call the implied multiples or the implied comparables. So again, if I look at EV to expected sales equals, from my DCF valuation, the Bloomberg equivalent enterprise value divided by, I'll do it for my income tab, my 2014 sales 1. Equals Bloomberg equivalent enterprise value divided by, from my income tab, sales 2, which is 2015 revenue. Next one is EBITDA equals my Bloomberg equivalent model enterprise value divided by, from the income tab, my forward 1 EBITDA, which is row 7 for 2014. Should I get that right? H7. And equals Bloomberg enterprise value divided by, from my income tab, 2015, so that would be I7. Same thing for EBIT equals enterprise value to EBIT1, which is my row 9, so 2014 H9 equals enterprise value divided by income tab I9. Next, I have my PE ratios, right? Price per share. Now, this is adjusted. So, price per share equals from my DCF valuation, my common equity value, divided by from my income tab for 2014. They're doing adjusted earnings for 2014. So in this case, I'll do net income. And in this case, I'll do income before extraordinary items for adjusted net income. But then they do subtract minority interest, so I'll use the net income line. Now notice that I'm way off because one of the things they're probably doing is they're probably taking out the non-operating gains and losses. So in our model, we go back here. In 2014, there's a non-operating loss of $1 billion. So they're probably adjusting for that. Now that's pre-tax. So what I'm going to do is come back to my comps and I'm going to take that and I'm going to add back to that from my income tab 2014 non-operating gains and loss. Where was that? There it is. Row 12. And then I'm going to multiply that by 1 minus the tax rate. Ratios 2014 tax rate. The correct order of operations. And therefore I'm going to get closer to the expected PE of the market. Because remember that the analysts are taking out with adjusted earnings per share as opposed to earnings per share. They're taking out the non-operating items. And the non-operating item is pre-tax, so we have to tax impact it. That's why I multiplied it by the 1 minus the tax rate. Okay? So again, I'm very closer to the expected PE. I'm going to do the same thing with the forward PE for 2 years out. So equals from my DCF valuation, common equity value divided by left paren, and I'll go back to my income tab for 2015. I want to take my income here, which is row 18. Income, which was that, I-18. And then I want to add back to that left paren the non-operating loss. So it's row 12. So I-12 times left paren 1 minus ratios 2015 tax rate. Right? So that basically gets me an expected PE in my model for next year. And finally, a price to book multiple equals price per share, which is the value of the company on the DCF value, the common equity value, divided by the book value of equity, which I can get off the 2013 balance sheet, which is the share capital plus retained earnings. All right. So here's the real point of this is that I'm relatively close because I'm relatively close to the Best Buy share price for these enterprise value and PE multiples. But here's the thing. So I'm just going to save my model for the time being. But let's say that I had a different share price. Go back to my ratios. And just for the heck of it, I'm going to make this 65. So let's say an $85 share price for Best Buy. Okay, I don't think that this is realistic, but I'm just kind of pointing this out here. When I do my valuation, one thing I'm going to have to justify is this ROIC chart. Okay, so when I do my valuation section, I'm going to do my as is. I say, and here's my assumptions. Here's why I made those assumptions. Here's the final valuation. Here's the assumptions I changed. Here's why I changed those assumptions. And then I do a buy, sell, hold. So given the Best Buy is around $40 today, at over $80 stock price, I definitely want to buy it. Okay, but then I had to come back and I had to justify this. So I had to show you the ROIC chart. And what the ROIC chart says is to justify an $85 stock price, Best Buy is going to have to get an ROIC somewhere over 70%, which they've never done historically. So that should tell us that this is probably not a reasonable valuation for Best Buy. Right? The other reason that I know it's not a reasonable valuation is I'm going to go to my implied comps. And in order to justify this valuation, then what it means is Best Buy would be trading an enterprise value to EBIT of 13.3 and 12.3 against an industry average of around 8. And the only company that's doing anywhere close to that is this rapidly growing small company in Texas and Louisiana. If you look at the much larger players, their enterprise value to EBITDAs are 8 or less. So a 13 and a 12, and again, enterprise value to EBIT, double the industry average, and an enterprise value to, PE ratio of 31, those don't look reasonable compared to what's going on with the rest of the industry across my realm of companies I'm comparing it to. So I have two ways of knowing that Best Buy is not worth $85 a share. Right? One is it's not going to pass the reasonableness test of the ROIC chart. And two, it's not going to pass what I'll call the implied comps. That the multiples that this forecasted share price would create doesn't look reasonable compared to anything that I see out there in the real world. And I probably can't come up with a justification to pay for that price. All right, so that's going to be the other analysis that you have to do. All right, so you have to do the implied multiples for your company that your final share price forecast, and then basically take those implied multiples and justify your final share price with the multiple. So it doesn't have to match up exactly, right? Because again, if our stock price is 40 and then we say 46 as our final, then obviously the multiples are going to be higher than what Best Buy is trading at. So the point is not to match the multiple. The point is to say, look, for the multiple I come up with, does that look reasonable compared to what I see people are willing to pay for these types of companies in the real world? Can I justify that? Or same thing, if the company's trading at a big discount, do I see that that's a level of discount that's appropriate given to the multiples in the industry? So it's just a second sanity check on our valuations, and it's another way to sync up the multiples that we see with the valuation. Now, when you're doing the multiple section of your project, very, very important, you don't want to talk about the implied multiples. Okay, so the person in your project that's presenting in the PowerPoint the multiples for your company or doing the write-up, you don't talk about the implied multiples when you do the multiple section. You do the actual multiples. The only way that the implied multiples comes up is in the final section when you're doing your valuation as an additional check against your final stock price. Now, for simplicity, when you do the PowerPoint slide, you could actually have the implied multiples on the same slide as the other multiples of the industry, and you can refer to this slide in both places. Okay? So you don't have to do two slides if you don't want to. You could put the implied multiple next to the actual multiple in a table and then use this for the multiple section, and you can use it for the final section. But I'm just telling you, when you're going through the multiples, you don't have to talk about the implied multiples. Right? It's only for the final valuation that we're going to do that. And it's based on your final stock price. And again, what you're just saying is, given my final stock price, here's the multiples that my final stock price implies. I think it's reasonable. I don't think it's reasonable. And by the time you get to your final presentation, it should be, I think it's reasonable. Because if it's not reasonable, then you should adjust. Okay, so that's just, again, another way of saying that I'm pretty comfortable with my final stock price valuation. Questions about any of that? Yes?
It's a pretty general question about assumptions and ratios. When you're trying to get the right price for it, you can pull a lot of levers and make it more complex and do all the research to like find which number, like, change it a little bit. Should you do that, or just kind of focus on the main levers like the revenue growth rate and the cost and all that?
Well, that's that's a great question. So the question is, just I'm repeating this for the purpose of the video. When you're working on your final projects, there's a lot of things that you can change in the model, and which one should you focus on? And what I've tried to give you this semester is what I call the 80-20. So the three drivers that we talked about are really what is going to be most of the valuation, and so I try and keep it simple. But again, there are always exceptions. If for the company that you're valuing, like they're going to make some dramatic changes to their balance sheet, and Best Buy might be an example of this, because Best Buy is slashing a bunch of stores, they're cutting a bunch of costs, that could actually change the way their balance sheet looks going forward. So it might be worth it for a company like a Best Buy to do some extra research. And if for another reason that we would have had to go to their 10K to figure out what the operating lease obligation was, because that wasn't being reported by Bloomberg, and that's a $7 billion data point, which is pretty substantial, because given their shares, it's $20 a share. Right? So I'm going to completely misprice Best Buy if I miss out on that data, which almost kind of infers to me in the real world, maybe that's one of the reasons why Best Buy's stock price has had a pretty good run. People aren't really looking at that operating lease value if it's not being reported by some of these data services. I hope that that's not the case. Institutions are usually smarter than that. But in any event, I would focus on those three. Now, again, you're welcome to change any of the others, but those are going to have the biggest impact. Because remember, for the balance sheet, we're tying all those balance sheet as a percentage of sales. So we're basically inferring a similar level of productivity going forward. And for most companies, it's not going to change dramatically enough that it's going to make a difference.
Okay.
All right, good questions. Any other questions? All right, so I'm going to pause the video here.